Hey guys, welcome to today's video. In today's video, I'm going to be talking about the worst investor on the show Shark Tank and why if you or somebody you know ever has the opportunity to go on the show, why you should stay away from this shark. If you've never seen the show Shark Tank, I definitely recommend that you watch it. It can be very entertaining, but at the same time it can be very educational. Basically what the show entails is people who are starting businesses or have already a couple years into their business come on the show, and there's investors there that they will pitch their business to. These investors either have multi-millions of dollars or even billions of dollars, and they will make offers, exchange for so much money for a part of their business. So sometimes the business is really good and multiple sharks will compete to give an offer to the person that has the business, or sometimes it's really bad and people will walk away without getting a deal from the sharks. But that's the basic concept of the show. People come onto the show looking for an investment, however many hundreds of thousands of dollars or even millions of dollars in exchange for a percent of their business. Now there's 6 main sharks that are on the show. And when I say sharks, of course I'm talking about the investors. Every now and then they'll have like a guest investor come on to look at businesses, but overall there are the 6 main sharks that are there 90% of the time. So the first shark is Mark Cuban, and he is the richest by far. He is richer than all the other sharks combined. He has a net worth of $4.3 billion. He also owns the Dallas Mavericks, and he has made a lot of money in tech. The second shark is Kevin O'Leary. He's a big wine guy, and he makes a lot of investments into like wedding stuff. Right now, his net worth is $400 million. The third shark is Daymond John. He found the streetwear brand FUBU, and his net worth is $300 million. The next shark is Robert Herjavec. His net worth is $200 million, and he's really big into cybersecurity. The fifth shark is Lori Grenier. Her net worth is $100 million, and she does a lot of stuff on QVC. That's that show where it's like a TV show, but it's basically a commercial for products, and they demonstrate the product, and they sell a lot of it. And the last shark is Barbara Corcoran. I'm sorry, I'm probably pronouncing that wrong, but she is net worth $80 million, and she's really big in the real estate. So the way that I discovered this or came about it was I watched Shark Tank a lot. I've seen every single episode. Right now they're in a new season, and every single Friday they release a new one, and the next day I'll watch it on Hulu. I'm really excited for it. I'm a super big fan, but I've noticed with this shark that he would offer the businesses exactly what they came into the Shark Tank asking for, and they still wouldn't go for it. So for example, a business would come in and they would say, I want $100,000 in exchange for 10% of my business. And this shark would say, I'll give you $100,000 in exchange for 10% of your business. And they would kind of look at him, and then they would like look at the other sharks and be like, does anybody else want to offer a deal? And I thought this was really strange. I did some research and I came across this Forbes article, and basically what I found out was that like the Shark Tank is not the end all. Even after they make a deal, the sharks still have kind of like a legal grounding to do some more due diligence into the company before they fork over that money. So maybe that person misrepresented their sales, or maybe they had some debt that they didn't bring into the conversation. Just because they shake hands on the show doesn't mean that the deal is legal and that it's 100% gonna happen. So I came across this Forbes article, and this is the amount of deals that were agreed to on the show, and then how many deals fell through after the show. Robert Herjavec has made 24 deals when this article was published, and he has backed out of 13 of them. So out of the 24 deals he's made, he went through with 11 of them, and he backed out of 13 of them. So he's only going through with 45% of his deals. So this makes a lot of sense of why people go on the show and they're not super interested in making a deal with him. Because if they make a deal with him and then he ends up backing out, then they miss the opportunity to make a deal with the other sharks. So this is really why like they come in and they're probably scared to do a deal with Robert, and they probably won't do a deal with him unless he's one of the last sharks left to make a deal. He's not the only one, but he's by far the worst percentage-wise on backing out of deals. So number 1 is Mark Cuban. He has made 32 deals, and he's only backed out of 4 of them. Next is Daymond John. He has made 27 deals, and he's backed out of 11. So still, he's backing out of a good bit of them, but still not near as much as Robert. Kevin has made 15 deals, and he's backed out of 6. So still, that's still pretty bad too. He's only going through with 57% of his deals, and he doesn't make a whole lot of offers. So I always thought that, if he was making the deals, he would go through with them. So I'm actually surprised to see that he's backing out of close to 50% of his deals as well. Barbara is made 28 deals, and she's backed out of 14 of them, so 50% as well. Lori has made 35 deals and has backed out of 18 of them. So Robert is the worst percentage-wise. He has backed out of over 54% of the deals that he's made. But there are plenty of the other sharks that I wouldn't want to deal with either. Lori backs out of a bunch of her deals. Barbara backs out of a bunch of her deals. And Kevin backs out of a bunch of his deals. So really, if I went on the show, I would only want to do a deal with Mark Cuban or Dave and John because they're the only ones that seem to come through. Now, of course, I might be doing the Sharks a bad representation here. Maybe it wasn't their fault. Maybe the people with the businesses lied about something, or maybe they misrepresented something. But it's really clear to see that Robert is backing out of the majority of his deals, and Mark Cuban has only backed out of 4 deals out of 32. So if you're ever on the Shark Tank or you know anybody going, definitely these are the sharks to look out for, and these are the sharks that you want to be invested with. If you have an idea or a business that you want to go on the Shark Tank with, which shark would you want to do business with and make a deal? Let me know why in the comments. Thank you so much for watching this video. If you enjoyed it, please let me know by leaving a like on this video. I make videos every single week talking about finance or really anything to do with investing. If this sounds like something that you would be interested in, please consider subscribing to my channel to see all of my great videos. Hey guys, welcome to today's video. In today's video, I'm going to be breaking down my $20,000 investment account. So before we dive into a breakdown of what my account is in, I just want to show my account right now. As you can see today, December 5th, my account balance is $20,963, and on the past month, I'm up 9.72%, roughly $1,850. So I've had a really good month and put me over 20,000, and I'm almost to 21,000. So super excited with that. Let's break down how I have my money invested. Right now, I only have 5 holdings. I have SPY, QQQ, and I have my 3 December stock picks. If you want to know what my 3 December stock picks are, definitely check out my video on that, and you can see which stocks I think are going to perform really well for the month of December. Now, getting into my account, I have roughly 80% of my account in SPY. That's an ETF that is meant to track the S&P 500 index. And I have 20% of my account in QQQ, which is meant to track the NASDAQ 100 index. It's basically the NASDAQ, but it excludes any kind of financial stocks, mostly like banks. So if you've never heard of an ETF stands for Exchange Traded Fund. They trade like stocks. You can buy them on Robinhood, Webull, Ameritrade, and it's just one thing, but it's made up of a bunch of different things. So the big one I'm in is SPY, and I have 80% of my account, like I said, so that would make up $16,770 of my account, or my equity. And I have 20% of it in QQQ, which would be $4,192 of my equity. So both of these ETFs are in a bunch of different things. They're super diversified, but they do have some overlap. For example, they are both invested in Apple, Microsoft, Amazon, Google, and Facebook. Of course, there's different weights, but they're both invested in these. For example of that, 6.37% of SPY is invested in Apple, and QQQ 12.79% is invested. So they're both in Apple, but they have different weights that are in Apple. So I have taken the big 5, which I said earlier, and these are how much I have invested in them. And this makes up over a quarter of my account. So if I took the weight of each one and divided it down, I have $1,604 of equity in Apple. I have $1,330 of equity in Microsoft, $1,170 in Amazon, roughly $900 in Google, and roughly $550 on Facebook. Now that's only 26.5% of my account. After the big holdings that they have, it starts getting really small. They might have 0.5% in this, 0.3% in that. So I didn't want to, just go down this whole list of all these micro investments, but it really shows that these are the biggest holdings, and it still only makes up roughly a quarter of my account. So I still have 3/4 of my account that are in very tiny percentages in each one. I will break down the categories though. So I found the categories and I broke them down for my account weighted, and the big ones are technology, consumer, and healthcare. When we say consumer, those are like retail and entertainment. So think Nike, movie theaters, stuff like that. So the big one is technology. 40.1% of my account is in technology, or $8,400. And that's probably all these big 5, Apple, Microsoft, Amazon, stuff like that. The next one is consumer. Like I said, that's retail and entertainment. I have 16% plus in that. And then the next one is healthcare. I have $2,600 in that one, or 12.4% of my account. So if you add up all these together, you get 68.8%, so close to 70% of my account. And that actually makes a lot of sense to me, and I'm happy to be invested in that. I really want to make investments in things that make sense, and I use technology. Everybody I know uses technology. I use consumer goods. Everybody that knows use consumer goods. I use healthcare. Everybody that I know uses healthcare. So yes, there's different micro investments you can make and a bunch of different things, but you really want to make investments in things that make sense and that are a safe investment and things that are not going to go away. So breaking down the categories, I have close to 70% of my account technology, consumer, and healthcare. Super excited with that. And I have about a quarter of my account in the big ones: Apple, Microsoft, Amazon, Google, and Facebook. Now, the reason I love ETFs so much is, one, it keeps it simple. The number one way you could diversify is you could buy 50 different stocks and you sign into your account and you've got, all of these different things. But when I'm invested in SPY and QQQ, it keeps everything clean and simple on my page. Now, you might not, care about that at all, but I think it's really clean, it's really simple, and you're getting the same effect. So right now, a share of SPY is roughly $370. You're like, oh, $370 is so much to put into one basket, but that one basket is included in all these different things. So you're really putting $30 into this, $20 into that, everything like that. It also pays a strong dividend. SPY pays close to a 2% dividend. It's been pulling back now because the stock is going up really quickly, but that dividend should grow and it'll get back closer to 2%. So I really love ETFs because somebody else manages them, a really big company, and all of my money, just takes care of it. So right now, the other thing I like about ETFs is that they can be adjusted and there's no change in the actual stock. So right now, QQQ has 4.2% in Tesla. Now, SPY has nothing in Tesla, but Tesla will be added to the S&P 500 on December 21st. So then SPY will have to take over some Tesla so that it will continue to track the S&P 500. So then some of my money, this $16,770, some of that money will now be invested in Tesla because it is now invested in Tesla. So my money can change and switch around, and it's being managed to track that S&P 500 to get that beautiful 10 to 12% a year. But I don't have to pull money out and put money in. So it just makes everything more simple. It's clean, and it's a great way to get a diversified portfolio without having to think about it and doing too much work. Thank you so much for watching this video. If you enjoyed it, please let me know by leaving a like on this video. I make videos every single week talking about finance or really anything to do with investing. If this sounds like something that you would be interested in, please consider subscribing to my channel to see all of my great videos. Hey guys, welcome to today's video. I hope you guys had a great holiday season. In today's video, I'm going to be telling you my 3 stock picks for January 2021. Before we get into the stock picks for this month, January 2021, let's see how my stocks for December 2020 performed. So at the beginning of December, I posted a video, December stock picks, and I posted 3 stocks that I thought would do really well. The first one I posted was Etsy. I got into it at the beginning of the month at market open, and I closed at the end of the month at market close. And I got a 9.52% swing just on the month. So super happy with that. There was no really big news with Etsy, but their stock has been on fire. If you look at the one chart, it's just going straight up very quickly. So I thought it would continue to do so, and it did. And I was able to catch a 9.5% swing. So super happy with that. The next stock was T-Mobile. I thought the good press about their 5G would really help them. Their stock was pretty much flat the entire month, but I did gain 1.02%. So super happy with that, 1% on the month. That's nothing to be ashamed of. And the third stock I picked was Apple. I got 9.7% executed. Apple came out and talking about they're going to start releasing electric vehicles sometime around 2024. So that really was good press, and that shot the stock up. If you take the 3 and you average them together, on average, I gained 6.75% on the month. So super excited with that. It's not the best I've ever done, but I'll never be ashamed to get 6.75% swung on a month. So this is my 5th time doing one of these videos. Was my 6th time. The first time I got over 16%, second time over 2%, third time over 7%. November 2020, I got over 20%. That was my best month yet. So in December 2020, this past one is when I got 6.75%. So super excited with that. Those are very, very strong gains just on 1 month. So my first stock pick for January is going to be NVIDIA. They have the stock ticker NVDA. If you don't know what NVIDIA is, they make a lot of graphics processors for things like gaming PCs. I really like this space right now. If you look at the statistics for viewership and the popularity, Esports is really starting to take over even mainstream sports. I've even seen they've started to play like esports on ESPN. They'll have like Rocket League, CSGO, and stuff like that. So this stock, kind of like Etsy, is on fire. On the past year, the stock is up 125%, and it's kind of starting to level off, but I think it's going to continue to trickle upwards. So a great swing trade for January 2021, and maybe a great swing trade for the entire year 2021 and onward is Nvidia. My second stock pick for January is Activision. They have the stock ticker ATVI. Activision is also in the gaming area like Nvidia, except they're gaming developers. Their big game right now is Call of Duty. What I really like about them is in their Q3 earnings report, their profit was over 20% higher than it was 12 months prior. So they're in a sector that's really growing, like the gaming section, like I mentioned earlier. And their stock is doing really well, and they're a leader in this area. So I think January is going to be a great month for them. My third and final stock pick for January is Disney. They have the stock ticker DIS. They've had really good numbers come out for their streaming service, and their park revenue is starting to come back now that we have looser regulations on the park, and the COVID vaccine will probably continue to make things better. Investors will see optimism in this, and they will likely buy the stock. So I'm feeling really good about Disney in January. And just like my last two videos, I will be putting my money where my mouth is. In my last two videos, I put $50 into each stock, but for this video, I will be upping it up to $100 into each stock for a total of $300 invested. Hey guys, welcome to today's video. In today's video, I'm going to be doing a basic but well-rounded overview on investing in the stock market. I'm going to be sharing you some literal textbook information as well as sharing my perspective on these topics, and I believe that at the end of this video, you will have either learned a lot or I will have at least challenged your perspective on some of these things, and you will become a better investor because of it. The first thing we're going to cover is a capital gain. The definition of a capital gain is the profit from when you sell property or assets. So say gold, stocks in a company, or even selling a house. If you buy something that's an asset or a property and you sell it at a later date and you sell it for a higher price, the difference from that higher price and the lower price would be the profit, and that profit is your capital gain. The main thing to understand with capital gain is the capital gain taxes. Now there's short term and there's long term. Short term is if you hold it for a year or less, and this is taxed at higher rates because it taxes your ordinary income. So think approximately 30%, maybe a little bit lower or a little bit higher. Long-term capital gain taxes are taxed at an actual capital gain tax rate, and this is 15%. It can be a little bit higher if you start making huge amounts of money, but generally 15%. So the main way I think about it is for an approximation, you're going to pay half the taxes on a long term that you would pay on a short term. Here is an example of why this is important to know. See here in situation A, you invest $1,000 into a stock at $100 per share for a total of 10 shares. After 11 months, the share price is $150 and you decide to sell. You have a gross profit of $500, but because you held less than a year, you pay the higher 30% capital gain tax and have an actual profit of $350. In situation B, you sell at $145 per share, less than you did in situation A, and you have a lower gross profit. However, because you held for the full year, you pay a lower tax rate of 15% and your actual profit is higher. See here the $382 versus $350. Now this might not seem like a whole lot, but say you increase it to a $100,000 investment, now the difference is $3,000. So the longer you invest and the more money you're making, the more important it is to know so you don't make a big mistake. The next thing I want to go over is the difference between trading and investing. Now, the price of a stock is determined by the market. If God came down from the sky and told you that this stock is worth $100 a share, well, if the market is only paying $80 a share, even though God just told you it's worth $100 a share, the current stock price is worth what the market is currently paying for it. So when it comes to investing and trading, investing is where you want to buy very strong, great financial, good growth, good long-term outlook stocks, because even if the market is wrong up and down, over time the market will kind of correct that and your stock will go up in value and you'll have great profits. You can put larger amounts of money into it, hold it for a long period of time. This is investing, something you're holding for 10, 20, 30 years. Trading is you're wanting to make a short-term profit based off maybe there's some good news that's coming out, or maybe the stock's just been on fire. But when you do this, you're speculating. So when you think trading, you're speculating what the market's going to do. Because when you're short term, the market's going to be wrong a lot. Stocks are not always fairly valued by the market. So when you're trading short term, maybe a week or a couple hours, you're playing the market, and it's a little bit more riskier than if you're investing over a long period of time. So that's the main difference between investing and trading. Diving a little bit deeper into this, let's look at the difference between an investor statement and a trader statement. Before you buy any stock, you should know why you're buying it and what your goals are. An investor statement sounds like this. I believe this stock will increase over time because of their increasing revenue, their profit margins, maybe they're currently undervalued. If the stock goes down in price, I will hold or buy more. A trader statement sounds like this. I believe this stock will increase soon because good press, good resistance, stuff like this. If the stock goes down in price, I have a stop loss set up to cap my losses. Let's talk market capitalization. Market capitalization, or market cap for short, is the value of a company. This is the price you would have to pay if you wanted to buy every single share of a company and own it outright. A lot of people see a company's share price and they think that that number is the value of a company. And that number is just a formula to determine the actual value of a company. So if you go into the statistics of a stock at the bottom where it tells you different things, you'll see market cap. So a company could have a market cap of $1 million with a $5 share price. They could have $1 million valuation with a $10 share price. They could have $1 million valuation with a $1,000 share price. It all depends on how many shares that company is broken into. So when you're investing in stocks, you're investing in that company at a current valuation, hoping that the market is going to produce a higher valuation for that company in the future. So a lot of investors, especially newer investors, will go on Facebook, Reddit, YouTube comments, and they'll read stuff, and a guy will type something like, this stock is currently at $10 a share. There's a lot of good news coming out about them. I think they're going to go to $15 per share. Now, if the only understanding that you have of that is a very simplified $10 plus good news equals $15, then you don't really understand what's going on there. The more sophisticated way to understand that is, say the $10 share price, which is what it's currently at, and you check the market cap and it says $1 million. So what that guy is really saying, even he might not even understand it this way, but what he's really saying is this company is currently valued at $1 million. I think because this good news is coming out about their revenue, the market is soon in the future going to value them at $1.5 million, representing a $15 per share stock price. So when you're investing in companies, you're not technically, of course you are quite literally investing in them at $10 a share, but the more genuine, sophisticated way to look at it and to think about it is, say you're putting $100 in, you're investing $100 into that company at a $1 million valuation because you think the market's going to value it higher in the future. Share price is kind of meaningless without the market capitalizations. Next, let's talk about dividends. I really love dividends. Dividends really feel like passive income, or that when people talk about mailbox money, the money that just comes while you're sleeping. So dividends are cash payments paid directly to you, usually every 90 days or every quarter, just for owning stocks. Now, not every single stock will pay out a dividend, but a lot of them do. But it feels really great every 90 days getting that money, and you didn't have to do anything for it, and it's just a cash payment. Now, when you get those cash payments, you can take it out and you can go buy stuff, or you can do the more responsible thing, and it's what I encourage you to do. You can use that money to buy more stock and increase your dividends over time. The next level of understanding for dividends is knowing that they don't pay out based on percentages. A lot of people will look at the stock statistics that we looked at earlier, and they'll see where it says dividend yield, and they'll know that that number is the percent dividend of the share price that it'll pay out. And this is a good way to find the approximate, if you just want a quick estimation for what the dividend paying out will be, but it's not the way that companies pay out dividends. Companies pay out dividends on fixed prices. So right here on the side, I've put up Coca-Cola's dividend history. Now this is paid out every 90 days. So if you look at the previous 4, add them up and divide it by Coca-Cola's share price, this is how you're going to get the approximate percentage for what it's paying out. The best and easiest way to get a decent return over a long period of time is just investing your money in the S&P 500 and leaving it there for years and years. The easiest way to do this is by buying the stock SPY. It is an ETF that tracks the S&P 500 and it also pays a good dividend. This is the strategy that I'm personally following, and the vast majority of people, this is what they should be doing. Trading is a very complicated thing to do and it's not easy. And majority of traders end up losing money. If you want the most simple, guaranteed way to invest money and make money over a long period of time, invest your money in the S&P 500. You won't have to look at it every single day, so you can focus on other things in your life, maybe your career, or your children, or your family, and you won't be staring at screens and be having stress every single day. Of course, the market will have dips. If you go look at the SPY during the coronavirus when it was really bad, it dropped a pretty good amount. I think it was around $330 a share, and it dropped to all the way down to $220 a share. So if you lost $100 a share and you had a lot of shares, that was a lot of money. But we hit all-time highs within a few months, and we're still continuing to hit all-time highs. For you to bet against S&P 500, which is pretty much the average of the top 500 companies in the U.S., you're really betting against America, and you're really betting that this country is going to fail. But people aren't going to give up. People are constantly going to be innovating, going to work, creating new companies, and the S&P 500 will pick the best companies that are performing. So this is the best strategy. I encourage you to use it, and the vast majority of people cannot beat this strategy. Hey guys, thanks so much for watching this video. If you liked it, please hit that like button. It's a really easy way to show support for my channel, and it really helps me out. You can find me on Instagram, Twitter, and TikTok, username @LandrumCapital. Again, thanks so much for watching and have a great day. Hey guys, welcome to today's video. In today's video, we're going to be talking about how GoodRx makes money. If you don't know what GoodRx is, it's a service that basically helps people save money on their prescription drug prices. So the reason I looked into this or even cared at all was from a personal story. So if you haven't seen the GoodRx commercials, it'll basically be like a mom with her child comes in for a prescription. The pharmacist will tell her the prescription is like $200 or something outrageous. And then she goes, oh no, I can't afford that. And her son start to walk out of the pharmacy. And then some stranger or a random good Samaritan will say, oh, just use, the GoodRx code. And the stranger shows the pharmacist the GoodRx code, and the $200 prescription becomes like $10. Whoa. I always thought this was interesting, but never really thought anything of it because I've never had this experience. But then I went to a pharmacy to pick up a prescription, and this friend of mine didn't have insurance, and the prescription was going to be over $60 per month. And this friend that I had pulled out her GoodRx code and showed it to the pharmacist, and it went from a $60 per month for a supply, and it came out to be like $15 for a 3-month supply. So now that I actually had experienced it, it kind of became real to me, and I just kept thinking like how does this work? Why is there this miraculous code? You don't have to create an account. You literally just go to the GoodRx website and put in the name of the drug, and you show it to the pharmacist and you get this huge discount. So I was like, what is this? How are they making money? And really, how is this possible?
No offense, but how?
So when I first looked into it with a Google search, I was hoping it was going to be a really simple answer. Maybe, some super rich billionaire started this company, and instead of, spending his billions of dollars, he's about to die or something, and he uses GoodRx to give all these good people, a discount on their prescription drug prices. But of course that's not true, and nothing in life is ever good and simple. There's different players in the game that you have to know about. Number one, you have the insurance provider. That's who you would have insurance through if you did have health insurance. They will hire a PBM, which is a pharmacy benefit manager. The pharmacy benefit managers, I could probably do 3 videos on them. They do a whole bunch of stuff, and I haven't even completely figured out everything they do. But one of the main functions of what a pharmacy benefit manager does is they will negotiate with the drug manufacturers for prices. And they are hired by the insurance providers. So the insurance providers hires a third party, which is the pharmacy benefit managers. The pharmacy benefit managers will go to the drug providers and negotiate a price. And then at this point is where it starts to get a little sketchy. So these PBMs, or the pharmacy benefit managers, go to the drug manufacturers and they negotiate the price. They don't tell the insurance provider or the pharmacies what they were able to negotiate that price for that drug for. So what the pharmacies have to do is they have to adopt what's called a usual and customary price. This is the price that a customer that has no insurance, that's paying cash, will pay for the drug. The PBMs, the pharmacy benefit managers, will only reimburse the pharmacies up to a maximum of what this usual and customary price is. But the pharmacies don't know how much the drug costs because that's not disclosed to them by the PBMs. So the pharmacies then have to estimate what's the maximum that they could be reimbursed by the PBMs for that pill. And when they're having to guess, a lot of times they overshoot it by a lot because they don't want to risk setting that price too low and then the drug costs more than that, and they'll only be reimbursed up to that cash price. They won't be reimbursed what the actual drug costs because the rule is that they can only be reimbursed up to the usual and customary price. And they can't set it exactly at the price of the pill because the PBMs don't tell them what that number is. So then the pharmacies overshoot it to prevent that risk. So that screws over the customers who don't have insurance because they're going there to pay cash and they have to pay this outrageous inflated cash price, and the pharmacies can't really do anything about it because they're not going to risk losing a bunch of money because they're not disclosed what that price of the pill is. So where GoodRx comes into this, GoodRx has partnered with these PBMs to give these customers access to cheaper prices, which sounds good, but not really, because the PBMs created the problem. They're the reason that we have the usual and customary issue, and pharmacies are having to set the price really high. So GoodRx has partnered with PBMs, or a number of PBMs, to where they get access to not have to go through that usual and customary prices. They can get access to the, kind of like a net cost of what the drug is. So the PBMs have created this problem. Now by partnering with GoodRx, they have a solution to the problem. Every time in GoodRx, you don't have to have an account or anything. You just type in the name of the drug, you pick the pharmacy you're going to go to, you go there, and you show it to them, and you get the discount. So the PBMs have created this problem, and with GoodRx, you go to the pharmacy, show the code, and they scan it. When you scan that GoodRx code, a fee gets charged to the pharmacy. Part of the fee goes to GoodRx, that's how they make money, and a part of the fee goes to the PBM. So the PBM has created this issue that's screwing over cash-paying, non-insurance customers, and then on top of that, they've partnered with these discount card pharmacy cards, because it's not just GoodRx, there's a different number of them, and with them, it fixes the problem because now the customers can get, actual affordable prices, and they make money off that too. So it really, from all my research, the PBMs seem a little sketchy to me. It's almost like if somebody is standing on the edge of a cliff and you push them, but in the last second you caught them, and then you're like, hey, I saved your life. It's like, yeah, you did save my life, but you also put my life in jeopardy. Now, I'm not a pharmacist and I'm not a business executive in here, so I'm sure there's people that are pharmacy benefit managers or they work for that company or stuff like that, and they do this, and they would all day explain to me all the work they do and why they're really not, like why they're the good guys. And it's possible that they are, but from my research, from what I'm seeing, it's just really interesting to me that they're not disclosing the drug prices that they've negotiated with the drug manufacturers. Why can they not disclose that price? If you're a consumer, you're kind of doing well because this problem is created by the PBMs, but by using GoodRx or another discount pharmacy card, you can get very cheap prices on your prescription drug prices. I've seen it, it's happened, it's a real thing that helps. I will warn you though, I did watch a video with a pharmacist talking about this, and he said that when you scan these discount pharmacy codes at the pharmacy, they have to send your name, your doctor, what drug you're prescribed. They have to send that to GoodRx, and then GoodRx sends them like the confirmation that they will reimburse them. When they do that, GoodRx gets a lot of your information, name, date of birth, your drug, your doctor, stuff like that, and that's data. And then they will go and they will sell that data to other companies. So it might be worth it to you. If a drug was $300 and now it's only $20, and you're like, hey, at least I'm getting the prescription drugs that I need. And of course, in this day and age, all of our data is being shared by Facebook and Instagram anyway. But that's just another thing to watch out about. Your data is being sent to GoodRx, and it's very likely that GoodRx is selling that data on the back end. Thank you so much for watching this video. If you enjoyed it, please let me know by leaving a like on this video. I make videos every single week talking about finance or really anything to do with investing. If this sounds like something that you would be interested in, please consider subscribing to my channel to see all of my great videos.